much, John. All right. Thank you so much, everyone. Glad to be with you on this Wednesday afternoon. And again, welcome to another episode of RM Smart Investing. Uh, what I like to do this week, kind of like to continue on the build up of our strategies that we started with the options. And last week we touched on straddle, and we noticed that with the straddle, what happens is purely is non-biased as far as the direction goes, but basically works on volatility. The thing is, though, again, it's kind of you want to be selective. We talked about make sure we talked about the squeeze, low uh, volatility, and very liquid stocks. Obviously, I like indexes as well. And so tonight, what I like to do is just follow up on that and basically have a little uh, kind of a lower out of pocket strategy, which follows on straddle. The reason I like to go this path is because once you understand the straddle strategy that I hope it was helpful last week, and once we understand strangle, and again, the strangle comes when you want to strangle someone, so you'll see why it's called a strangle. So with these names, straddle, remember we saw that lady, and then this time it's strangle. We can build on these, and we can actually have a lot much easier time to work on things like iron condors or iron butterflies or pure condors and butterfly. And again, we can talk about broken wing butterflies. So basically building on that, I think that will be very helpful. So that's why I think tonight, again, we're going to focus on strangle, which is, again, once you understand it, straddle, it's a lot easier to grasp when to use strangle and how to apply that, especially with the markets that the way they are. It allows you to have another strategy, which is pretty low risk in some ways that it's not a lot of out of pocket. So with that in mind, I'm gonna share my screen and, and we can go ahead. I hope everyone sees the screen and we'll go ahead. So mainly tonight, I'm going to talk about, and last week we talked about long straddles and long strangles. And basically what we mean by that is, again, we're talking about a low volatility. So this is a volatility game. And since we think that the volatility is low, and we think there is a good chance that the volatility will be expanded, what will happen is we want to be long or buying this strangle. On the other hand, there are events, and you will see a lot more of that, and you have seen more of that, is when really volatility has expanded and you feel that volatility could be contracting. And at that time, you want to be a seller or collecting the premium of the either straddles or strangles. So in this situation, what you want to do is then again, you are taking obviously much higher risk in the sense that, again, you are collecting the premium, but on the other hand, the probability is most likely on your side. So um, talking about strangle, last week we talked about what straddle was. A straddle was buying really at the money option, both call and put, and you just didn't know which direction it will go. All you knew that the volatility has really contracted. There's something could happen in the next few weeks that you feel that whether it's in the squeeze, whether that expected move, you look at the expected move and you feel, well, it's been really low. So compared to what the expected move will be for next month, next week. And then also it allows you to, again, in putting a predetermined amount of premium and hoping that it will actually have a bigger reward. So the problem with the straddles were that they were actually at the money, and at the money, as you know, So when you buy both call and put at the same time, well, you got to put a higher amount of premium. What Strangle does, it's, I don't want to call it the poor man's straddle, but Strangle is exactly same concept. Again, you're working on a strategy that you think the volatility is going to play, uh, again, a big role. So you don't know which way it's going to go. All you know, you think it's going to expand. Something is going to happen. So basically, you use the same underlying asset, whether it's stock or futures. You use the same expiration date, so it's the same month or week. The only difference between this one and straddle is you're actually buying out of money call option and out of money put option. And what that means is obviously when it's out of money, you put out less out of pocket. The premiums are much lower because again, it's out of money. That's the only difference. So other than that, basically it works the same way. But it is a good strategy in the sense that once you get a little more used to this, then you can actually, I've used it like even in earning plays. With straddle, I mentioned, don't want to have the binary events, but sometimes if you want to be really aggressive, I've done it like the minutes before the earning comes, and I look at what is the expected move, and we'll discuss that a little more. So this is where you can actually take advantage of strangles. So basically what it does, Strangle, if you recall, we did have, let's say at the money, we bought put and call at $40. With Strangle, what you do, you actually buy out of money calls and you try to have them equal distance. So I buy a call of 45 and I buy a put of 35. So basically both of these are out of money. So if for $40 at the money, it costs me $4, let's say $2 for the call and $2 for the put, a $45 call might cost me 50 cents, or I have to pay. And 35, usually it's a little higher, but let's say it's the 50 cents. So it's the comparison is I'm paying $1 for the similar idea, and for the on the other hand, for the straddle, we paid $4. So really you're minimizing out of pocket. The difference will be that you want a big move. So if you bought a call of 45, you want to have a big movement, big movement. You want to make sure it is going to go outside your expected move of 35 and 45. So that's the difference. And that is the reason we will compare what strangles compared to straddles. For instance, again, the advantages of both of them, both strangled, long straddles and strangles, is your profits could be unlimited. And why is that? Because you're buying a long and a put, and if you hold on to it, maybe an event happened and then the call could actually go, or the put, it really can go as high as it could be. So basically theoretically your profits are unlimited. Again, it's when you buy something, that's what it is. You have unlimited profit, but you have obviously a predetermined risk, which is the premium that you paid. So the advantages are that you have, could be, if it is a volatility comes in, it's a big event, then you could have a good profit. And that's what you're betting on, the volatility, because it's going to help you to obviously pay for, make a profit. The maximum loss is, again, is the premium that you paid. Now, the disadvantage is you have to remember with the strangle, you really are in between the 45 and 35. Your goal is to go beyond that. So you really need a large move. You're hoping that coiling has really been working and eventually it's going to break out. And on the other hand, if the volatility keeps declining, and we talked about last week, we talked about, again, volatility, we talked about the Greeks, the time decay and the vega, or the volatility and gamma, they play a big role. So in this case, as volatility declines, so does your premium. And obviously the time decay, depending on how long of a time you're holding these straddles or strangles, that also plays a role. Now, I'm not going to talk too much about short, but this is a complete opposite of the long. So basically you're hoping that when you're shorting something like strangle, you're hoping the volatility is going to contract. And you want to make sure, again, that expansion becomes contraction. So because of the declining, again, the volatility, it helps you. And basically the time decay, as you know, when you're selling, it's going to help you as well. So let's talk about, again, the strangle. This is selling strangle, the form. So you can see here we have a lot more wiggle room. So that's what you have. You can, you know, the movement is bigger here than the straddle. So basically, let's think about the difference between, again, the straddle and strangle is the selection of the strike price. So it's at the money versus out of the money. Again, you want to try to have it equidistance, and that's how they're more out of the money. So in the situation with the straddle, we buy and sell both options at the same strike price. On the other hand, with the strangle, it's a different strike prices. And when we say buy, obviously I mentioned you go long and you have a predetermined long premium payment. And when you sell it, obviously you're collecting the premium. Okay, so one of the things I thought, so I hope that has been clear. So with strangles, basically, again, you can use it. I mentioned we can go back on the straddle when we talked about you want to work with the very liquid stocks. So let me go back. You want to work with the pretty liquid stocks. You don't want to pay high premiums. So remember the spreads. What you want to do also, you want to make sure, again, there's a high volume, good open interest. With strangles, I've used, again, as an earning play. That could also be, you know, an event. You can, we talked about screening. You can look at like the squeeze. You can look at the screening of some of the stocks that with the expected move. And so because, again, we emphasized the straddle last week, this is just a play on that. What I want to do, I just want to share with you something as a more of a day trading. That's something that a lot of people don't use. They use the strangle for more of a long term. Maybe I've mentioned, again, you can use it with weekly. I mentioned I can even use it for like a day. You know, I've used it on an earning play. I've used the strangle depending on the history. So what I've done, I use Google, for instance. I wouldn't use like something like Netflix or Tesla. Tesla will chop your head off. You don't know what. But some of the things I used to know, like I used to watch Google's patterns, and I used to watch seasonality, like April. They used to just, first of all, they always beat, but they, most of the time they went above and beyond the expected move. So with those information that you can find, it's a little, you have to do research. So you go back and seasonality wise, Cisco used to be a good one. I know many, many years ago. Now, unfortunately, I mean, Cisco looks more like a mature company now, but you know, those companies nowadays, you know, you can look at Apple, for instance, and some of these companies, you have a history of their earnings and watch the quarterly earnings, and you do have access to the, you know, let's say last 20 quarters, for instance. And you want to have the, you want to make sure there's enough cycles. So, you know, you had expansion, then, you know, you want to have, and as far as contraction, so if you can, the longer you can go, the better it is. But you will notice that some of the quarterlies, they're exceptional. And based on that, you can kind of anticipate if it's a good idea for the earnings play to play strangle. So as you know, we do have the expected move. And based on that, for the monthly, which is going to be the next screen I'll share with you, then that's important that you can play that as far as the earnings play. The other thing is, the difference between strangle and straddle, Straddle has a higher probability of success than Strangle. So the more premium, or the less premium that you pay, the less the chances. But the thing is, that Straddle is about 40% odds in your favor. It Strangles about 30%. Now, next week, I think we will follow up and maybe talk about Iron Condor and compare Iron Condor with like Strangle, see how that works. So Iron Butterfly with Straddle, because they really just follow the same pattern, and but it kind of minimizes your risk or out of pocket. So those are really wonderful strategies, and that's one of the reasons I really like you to learn more about the options, because it's again, I've said, mathematically oriented. You, regardless of what, again, the underlying asset does, sometimes your strategy becomes more important than just the underlying asset, basically by studying the volatility, looking at the time decay. And so you could be wrong about the direction, but yet still be profitable. So going back to this, so what happens is, as you know, the option, the market makers, they look at and they give you the, you know, what is the odds and basically the movement, the expected move. So I'm just talking generally because I want to give you a specific example about day trading strategy that you might be able to use. So basically, as you can see, based on that, you can go back and study every, you know, as I mentioned, with, let's say, Apple, or even look at the banks, for instance. But a lot of time the technology stocks are more attractive. You can look at the surprises, for instance. There is a screen that what stocks have had upside or downside surprises. So they go above and beyond this one standard deviation. So these are all one standard. So that's where you can use the Strangle. And again, you don't know which way the market's going to move. You're hoping, you know, when you buy directional, you might go buy out of money, but that's, again, you're basically, you're looking at the 50-50, unless, you know, as I mentioned, the seasonality, you might have seen that there was a big bias toward like an upper movement. So let me share with you something with the day trading. And what this is basically, I emphasize, this works very well with the indexes. So let's say you have a spiders or IWM. You want to make sure they're liquid. QQQ will fall in its place. And then you could also use maybe Apple or Amazon. But I want to work on spiders because they do have a pattern. So for instance, you look at the spiders, let's say it was Sunday, let's say Monday evening, you looked at what is the expected move for the day. One of the good things about these indexes, they actually have, you know, the weekly, actually 3 times a week. So with, let's say with spiders, you know, you can play Monday, Wednesday, Friday. So you can actually, let's say today was Wednesday, and this is an example. I didn't do it. I just wanted to show you what it is. So with spider, you look at, this is about 10:15 a.m. I took a picture of it. So it was at 3:48. And what happens, this is a lesson I think I will go on Saturday. The patterns of what happens when in the morning the markets open up and I look at the futures, really there's 3 things could happen. So either market is going to really fly out, it's going to rip the heads off of, let's say, their shorts, or completely go down, or it's going to be trending nicely, or it's going to be choppy. Believe it or not, most of the time, S&P or the markets are range bound. Granted, you see the volatilities, but 60 to 70% of the time, it is a range bound. And that's what you can make, you know, again, by predicting, actually looking at that pattern, you can, you know, make some good anticipated trades. So if there's a trend, if the market, let's say Monday was a good example, I will show you, I will share with you on Saturday, I think, for the lesson of the week, how the trend works and how the lunch hour things work. So this was about lunch hour. So the markets were getting a little choppy. So one of the things you could do for Strangle, when you see that compared to the weekly options, you have gone down, and the expected move is like really narrowing. You could use a 30 minutes, you can use 15 minutes, or 30 minutes is pretty good. You can see we are like in a slow part of the day. That's one of the ways you can play Strangle. And again, I use Spider. So I'm just gonna go over that. So how you actually put the trade in. So I just looked at the sizzle index, and I see there's no favoritism here. I noticed, like, this was again at 10 o'clock, you'd see that there were a little more puts than calls. You could understand because the markets were down, and obviously the news came out about which we had discussed last Saturday about this stimulus package. Most likely will be a no-go. But you can see there was really no favoritism between calls and puts. So basically what you could do, this is a good place, maybe buy and Strangle at 10:15 a.m. So I use that time, and I will explain it on Saturday why. But this is something you could do. And then, oops. And this is what it was. So October 14th, which is today. And you can see it's about 12.8% is the volatility range. And then the movement was $1.71. So at that time, I was looking at the 348. So my thought process was, well, there's expected move of $1.70. So I could, again, I didn't do it. I'm using this example because things were choppy, but I just want to watch it every day. You can see where the mentality comes from. So I suggested then maybe I can buy a $2 out of money call and a $2 out of money put. So that translates to 350 call and 346 put. And what happens is I will pay a premium for that. Again, this is on a weekly, so which was at today's expiration. So this is what happened. And for some of you, again, if you haven't done this, so let me go step by step how we can do this, how we can actually put a trade in. So you have two ways. Number one, you open the option chain. That's October 14th. That's 2020. Our underlying investment is, again, this is Spiders. So it's expiring today. Here, you have a drawdown. So you usually says single. So if it's single, it just tells you what is the price for 348, 349, 350. And then you can pick and choose your target. So what I thought, well, I said, let's use the strategy, and let's say it's a Strangle. So we choose a Strangle. And once you choose a Strangle, it automatically chooses with a dollar spread in a sense. So in this situation, I'm looking at, so it came with that, let's say you could do 349 and 348 put. So that's not what I wanted. I wanted a $2 spread because the expected move was $1.79. So once you just, because you're buying, you go to the ask. You just click on ask, and that will buy that Strangle for you. If you press bid, that will sell the Strangle. So we're gonna just work on ask. So I press this, automatically goes to green. That means you're buying. So I was gonna buy 10 contracts, for instance. And here is where you can, as you can see, you can play with the numbers. So basically you can pull that, you wanna call 350, which is $2 above. And then you can, $2 below is 346 put. Everything is ready. Here, the debit is only 35 cents. So basically what happened was my out of pocket is gonna be, again, for one contract will be $35. For 10 contracts will be $350. That's it. So then I put buy, and then, I confirm that. So how do you play this? Now, today did not go accordingly completely, but let's say if there was a squeeze, I just want to sort of the analogy, and the markets were really, it's a lunch hour, it's quiet, but you know something is happening, it could go either way. You don't know. So all you need to know is if your call, if let's say it moved completely up, if the call option moved above at that 35 cents break even, for instance, right? So basically, let's say all of a sudden your call option is worth 40 cents or more, you can sell your call. Now you've recouped all your money because your out of pocket was 35 cents. So now it goes up. Either way, we use the call in this situation. You're in the money, you got 40 cents, 45 cents, whatever. And let's say it's like 11:30, 12 o'clock West, Pacific time. You still got another hour. You sell that call, but you hold on to your put. Because if the market's reverse and let's say there was a big move, you still have some kind of a time value left. And then what you could do, you could actually, even if it ends up worthless, at the end, what will happen, you actually got 45 cents on your call side. So you still are a winner. But even if it goes, and let's say the market's turned around, it's the last hour, 12:30, things are going your way, then you can actually sell your put. So you can win from both sides. So as you've noticed in the past, I've said I don't like to take, when you have multiple legs, you want to stick with it. And so if you're playing again, you're looking at a monthly option, you're looking at something that 60 days, 50 days, 35 days out, you don't want to be one leg at a time. You just want to do both, especially in vertical spreads. You've noticed that's very important, especially when you're selling. You always, by the way, when you have a leg that you have a sell and a buy, you always close your sell first and then you close your buy second. Make sure of that, whatever you do. But normally I'd suggest do it at the same time. With this, our day trading strategy, this is the only one of the few times that you can actually be selective. If the markets are going your way, then you can actually take the profitable side, sell your call, and then wait. Maybe if it turns around, then you can actually take profits on the second leg. But I thought this might be helpful. This is something that, again, I've seen, I play the futures, but I've seen it, and I also do options. For instance, I'll share with you like Monday, as you know, the markets were just going gung-ho, and about 12:30, with the Tuesday coming, the turnaround Tuesday. So I bought put options. So rather than buying futures, I day trade the futures. I don't like to hold on to futures overnight. I like to have, first of all, the margins are 3 times required almost. And so the daytime margins are much lower for futures than overnight. So I don't like to leave that and, keep my margins open. So basically, but I like the option. So I bought a Wednesday's option on Monday, and Tuesday, as you know, it was pretty volatile and it worked out pretty nicely. So that's when you can play options. So even for day trading, we talked about gaps. You can play day trading for that. So as I mentioned, Saturday, I will go over the lesson of the day, basically on the trending, how you can actually do a day trading using options if you like. But how to understand the pattern of the day trade for the markets. So, but this is one of the few times you can play options the same day and actually take advantage of the movement. So I hope this is helpful. As I mentioned, the following week, you will see how everything comes out nicely. For instance, when we play Iron Condor, how it's based on, let's say, Strangle, and then we will compare which way is better, Strangle or is this Straddle better versus butterflies or iron butterflies? Is this Strangle better versus condors, iron condors? And hopefully everything comes together but especially if you've been, studying the vertical spreads. So everything again, we're talking about strangles, spiders, straddles, they work on the volatility. We talked on vertical, which works on, again, the probabilities, most of the time on your side, the time decay favoring your side. Then we combine that with the iron condors. Now we can take advantage of, again, having the limited risk and also have a higher um, payout in the sense of the probability. So with that in mind, I just want to emphasize just on Strangle today and just basically work on like this day trading idea, and I was hoping that might be helpful. So with that, I am good to go, ready for questions. If there's anything, please go ahead and ask me. If any ideas, any suggestions, I'll be more than happy. So Sean, this is